Hello, everyone. Welcome to the weekly lecture videos once again. And this is the last video of this chapter. In this video, I'm going to cover the third learning objective of this chapter, identify the essentials of short-term financial plan. So I will start with cash budget. The cash budget is a primary tool in short-term financial planning. It allows the financial manager to identify short-term financial needs and opportunities. Importantly, the cash budget will help the manager to explore the need of current borrowing. The idea of the cash budget is simple. It records estimates of cash receipts, that means cash in, and disbursement, that means cash out. The result is an estimate of cash surplus or deficit. Okay. So how it works, we will see an example soon. So first of all, to prepare a cash budget, we identify sales and cash collection. Okay. And you can see a formula for cash collection is the beginning account receivable plus half into sales. And then we identify the cash outflows. Okay, you can see that there are several cash outflows. For example, the payments of accounts payable. These are the payments for goods and services rendered by suppliers, such as raw materials. Generally, these payments will be made sometimes after purchase. Then wages, taxes, and other expenses. This category includes all other regular costs of doing business that require actual expenditures. Depreciation expense, for example, is often thought of as a regular cost of business, but it requires no cash outflow, so it is not included here. Capital expenditure, these are payments of cash for non-current assets. And last of all is long-term financing expenses. This category includes, for example, interest payments on non-current debt outstanding and dividend payments to shareholders. Okay, so we identify the sales and collection, and we deduct the cash outflows to get an estimate of a cash surplus or a cash deficit. So Fanto is the corporation's cash budget example. You will see that this example is also available in the textbook, so you can manage some time to go through the example. So here I will briefly explain this. What we are given is expected sales by quarter. So you can see quarter 1, quarter 2, quarter 3, and 4 sales are given. We are given with beginning account receivable, which is 120. And the collection, this formula I already showed you in the last slide, that collections are beginning receivables plus half into sales, okay? And accounts payables are 60% of sales. These are given. We are also given that wages, taxes, and other expenses are 20% of sales, and interest and dividends are 20 million per quarter. There is a major expansion plan in quarter 2 that requires 100 million. Okay, we are also given that beginning cash balance is 20 million and a minimum cash balance of 10 million. Minimum cash balance 10 million means we will always hold this cash in our hand. Okay, so now you can see the cash collection first of all. So what we have is, you can see, is the beginning receivables that we were given. We were also given sales, 200. And then cash collection is calculated using the formula that I have shown you in the previous slides, that collections are the beginning receivables, for example, here, which is 120 plus half into sales. Sales is 200, so half of sales is 100. So 100 plus 120, so cash collection is 220. Okay, 220, and ending receivables is beginning receivables plus sales minus cash collection. Okay, so that is ending receivables. So these ending receivables of quarter one essentially is the beginning receivables of quarter two. Then we do the same calculation again, and ending receivables of quarter two is essentially the beginning receivables of quarter three. So this is how we calculate cash collections and ending receivables. Okay. Then we were also given the cash disbursement. You can see, so our payment of payment for the sales is 60% of sales. Every quarter wages, taxes is this. You can see, I think that was 20%. Then capital expenditure is the 100, which is planned in quarter two, and long-term expenditure is this. So this is our total cash disbursement. Okay, so you can see we have cash collection here, we have cash disbursement here. So then we get cash collection minus cash disbursement. So that is our net cash flow. Okay. So now we calculate our cash balance. You can see beginning cash flow that was given $20. Then is our net cash flow comes from here. You can see. Okay. So beginning cash 20, net cash flow 40. So our ending cash balance is 60, right? And our minimum cash balance is 10. So 10 is what we must hold. So we have a surplus cash of $50. Okay. And once again, this ending cash balance of quarter one will be the beginning cash balance of quarter two. Then with the same calculation, and ending cash balance of quarter two is the beginning cash balance of quarter one. And we keep doing the same calculation. Okay. So you can see that due to the seasonal needs and also for the capital expenditure, the quarter two cash balance is negative, which means that they have a cash deficit. So it is reduced down to -5 in quarter three. But again, perhaps due to seasonal demand, it increases to 20 in quarter four. Okay, so when there is a positive cash balance, estimated positive cash balance, the firm should plan to invest this cash, and when there is a deficit, the firm should plan how to finance this deficit. Okay, now short-term financing and unsecured loan. Okay, so from the previous example of FundToys cash budget, you can see that FundToys has a short-term financing problem. It cannot meet the forecasted cash outflow in the second quarter from internal sources. Okay, so how it will finance the shortfall depends on its financial policy. With a very flexible policy, FundToys might seek up to 60 million in non-current debt financing. Okay. In addition, note that much of the cash deficit comes from the large capital expenditure. Arguably, this is a candidate of long-term financing. Nonetheless, because we have discussed long-term financing earlier, we will concentrate here on two current loan options. One is unsecured loan, another is secured loan. Okay, so let's talk about unsecured loan first. The most common way to finance a temporary cash deficit is to arrange a current unsecured bank loan. Okay, firms that use current bank loans often arrange a line of credit. Okay, a line of credit or a bank overdraft. Okay, these financing arrangements are very similar, so we will limit our discussion to the bank overdraft. Okay, now what is a bank overdraft? A bank overdraft is an agreement under which a firm is authorized to overdraw its bank account up to a specified amount. Okay, to ensure that the overdraft is used for short-term purposes, the borrower is required to make sure its bank balance fluctuates by periodically repaying some of the loan, and then when required, it can borrow up to the overdraft limit. Okay, banks like to see the line being used, but not being at its limit continually for the whole year. Okay, short-term lines of credit. Short-term lines of credit are often classified as committed or not committed, right? The latter is an informal arrangement that allows firms to borrow up to a previously specified limit without going through the normal paperwork. A revolving credit arrangement, which is also known as revolver, is similar to a line of credit, but it is usually open for 2 or more years, whereas a line of credit will usually be evaluated annually. A bank overdraft is technically at call, meaning the bank can ask for the money back at any time. Interest rates on bank overdrafts are set by the bank, and a fee is charged for the provision of the overdraft facility, even if it is not used. Okay. Committed lines of credit are more formal legal arrangements and often involve a commitment fee paid by the firm to the bank. The interest rate on the line of credit is usually floating. A firm that pays a commitment fee for a committed line of credit is usually buying insurance to guarantee that the bank cannot back out of the agreement, okay, provided there is no material change in the borrower's status. Now, let's briefly talk about secured loans. Banks and other financial institutions often receive security for a current loan, just as they do for a non-current loan, depending on the credit risk of the borrower. Security of current loans usually consist of account receivable or inventory or both. So first of all, account receivable financing. Account receivable financing involves either assigning receivables or factoring receivables, okay? Either assigning receivables or factoring receivables. Under assignment, the lender has the receivables as security, but the borrower is still responsible if a receivable cannot be collected, okay? With conventional factoring, on the other hand, the receivable is discounted and sold to the lender. Okay, lender is the factor. When it is sold, collection is the factor's problem, and the factor assumes the full risk of default on bad accounts. Okay, with maturity factoring, the factor forwards the money on the agreed upon future debt. Okay, so you can see that in the case of factoring, the collection is the factor's problem. Inventory loans. Inventory loans are current loans to purchase inventory, and they come in 3 basic forms. Okay, blanket inventory lien, bailment finance, and field warehouse financing. So first of all is blanket inventory lien. A blanket lien gives the lender a lien against all the borrower's inventory. Okay, so the blanket covers everything. And the bailment finance is a device by which the borrower holds a specific inventory on bail from the lender. Car dealer financing, for example, is provided by wholesale bailment. This type of secured financing is also called floor planning in reference to inventory on the showroom floor. However, this can be used only for sellable inventory, not for raw materials or partly completed goods. Field warehouse financing is a public warehouse company acts as a control agent to supervise the inventory for the lender. Okay, so this is field warehouse financing. Now, very briefly, some other sources of financing, for example, commercial papers, commercial paper, and trade credit. Okay. Commercial paper consists of short-term notes or commercial bills. Okay. So it could be short-term notes, commercial notes or commercial bills. Commercial notes are promises to pay a sum of money in the future. Okay, they are normally issued by large and highly rated firms. Typically, these notes are of short maturity, ranging up to 180 days. Because the firm issues these notes directly, the interest rate depends on the borrowing firm's credit rate. A commercial bill is a negotiable instrument that requires payment at some time in the future, usually between 90 and 180 days when issued. To remove the credit risk of the promissory notes, the borrower engages a bank to guarantee payment, which gives rise to the name bank bills. Okay, the bank substitutes its credit rating for the borrowers and changes the borrower's fee for the service. So another option available to a firm is to increase the accounts payable period. In other words, it may take longer to pay its bills. This amount of borrowing from supplier in the form of trade credit. This is an extremely important form of financing for smaller businesses in particular. Okay, so as we will discuss in the next chapter, that a firm using trade credit may end up paying a much higher price for what it purchases. So this can be very expensive source of finance. Okay, so this is the end of this video, and so is the end of this chapter 2. So just don't hesitate to let me know if you have any question about any of the topics we covered in this chapter. Thank you very much.